I want to show you something because a lot of times I talk about the valuation of a company in relation to revenues, especially when the company is not yet profitable. So I want to use an example of an honest company that I talked about before. Jessica Alba, diapers, right? Honest diapers. If you look at this chart, the stock used to be close to $20 when it IPO, and it's down like 92%. And anytime you have something down, you can't just say, you can't just make a judgment based on that alone, because it might be a good opportunity or it might not be a good opportunity. If you look at the market cap today, 130 million, right? And if you look at the financials from 2022, revenues were over 300 million. So 130 market cap divided by revenues of 313. That's like 42% of revenues. It's not even 1 times revenues. It's not 2 times revenues. And when the stock was trading at almost $20, it had a market cap of 1.4, $1.5 billion. It was trading at like 4 to 5 times revenues, right? And now it's trading at 0.4 times revenues. So you might say, whoa, that's cheap based on revenues. But here's the thing. First of all, you have to think about, or I think about, is what is the quality? What is the quality of this revenue stream? First, I want to look at the gross profit margin. So 107 divided by 300. Back then, gross profit margin was close to 36%. Then 2001, gross profit margin was 34%. Then gross profit margin was 29%, right? So declining. And the most recent quarter, gross profit margin is 24%. So it's not a very high quality revenue stream from the point of view of gross profit margin. That's number one. Because after you generate gross profit, you have to sell the diapers or whatever. Because remember, what are they doing? They're selling things to retail stores. Some of it is online, but they're selling through retail stores. And they have somebody manufacturing it for them, right? So to retail stores are in intense competition with Amazon, with other retail stores. Retail stores are pressed because of inflation. So retail stores are going to press them on the price. So honest company doesn't have any pricing power with retail stores. And also the products that they sell, they're not really anything. People can switch from this diaper to this diaper. And then the competing companies are bigger, larger. They have lower cost of production, right? So The retail stores are pressing them on price, so they can't sell it for a high price. The people that manufacture it for them, uh, the honest company doesn't really have very much bargaining power, so they're going to press them on price. They're going to require them to pay as much as possible because they're also pressed by inflation to pay for these products. That's the cost of revenue, cost of goods sold. So they can't sell it for a high price. They have to pay a high price. They are getting squeezed on margins. That's why the margins are not that great. They went down from like 36% to 24%. Now, that's just making the product. Well, after you make the product, well, you got to expose it. You got to market it, right? If you have a product and you put it in a big box store, do you think the big box store is going to give you space and it's going to put all this energy into making sure that people buy your product? No. Big box stores require you to pay for marketing, so you drive the traffic to the store and you are the benefit to the big box. So that's why after you get your gross profit, which is now 24% of your sales, then you have to spend a lot of money marketing it, right? Marketing it. And look at this. If you compare in 2020, about 45% of your gross profit needed to go to marketing. The following year, about 55 million out of 110 needed to go for marketing it. So we're getting close to 50%. So let's do the math. 44 divided by 107. 41% in 2020 had to go to market. 41% of gross profit had to go to market the product. Then in 2021, 49, almost 50% had to go to marketing. And in 2022, 51% had to go. Let's see in the first quarter. And then in the first quarter, also about 50%. So again, you have a very tiny, you get squeezed on the margins. So your margins went from 36 something to 24%. And then you had to increase the marketing to market the revenues that are lower quality revenues. That's not a very good business. But then marketing, that's just part of it. Then you have selling, general, and administrative. That's, for all these years, that's almost double the amount that they had to spend on marketing. So when I look at a revenue like this, I don't like the quality of revenue. They're getting squeezed on both ends, from the sales price and then from the production. They have to market it heavily. And they have big selling and general and administrative expenses. Okay? So for me, it doesn't matter if the company is selling at 3 times revenues, 2 times, 10 times revenues, 0.4 times revenues, 0.1 times revenues, because at the end of the day, I don't see how this company can be very profitable, successfully profitable in the future. I have doubts about that. There's nothing special about this product. Competitors are plenty. It's not like they have something special that nobody else has. It's not like they have access to certain data that nobody else has, and then they can come up with new solutions for an outdated system. No, diapers have been around for a long time. Competitors have a very good way of producing them. There's nothing special about them. So I don't really care if if they're selling for, 1 times revenues, 0.4 times revenues, or 0.1 times revenues, because I don't see the light at the end of the tunnel. I might be wrong, but we'll see. I don't see the light at the end of the tunnel. And if I don't see that the company down the road can be profitable, I'm not interested, because the value of a company is based on the present value of future cash flows, future profitability. I don't mind if today the company is not profitable, as long as I see a path, I see products being produced, or I see something that's going to make them profitable, then I'm like, okay, in the future they're going to make so much money based on that future cash flow. It looks like I'm getting a good deal today. But with something like Honest Company, I don't see that future cash flows being great. I don't even know if they're going to be there. So it doesn't matter what the price is. I'm just not interested.